traders, and welcome to a new market theory video of mine. In today's video, we're going to be talking about predicting a trend. As you can see, this was my Patreon suggested video that I had. So the first thing that I want to say is that this video is going to be looking at market theory to exploit retail traders. We're not going to be talking about institutional traders or arbitrage traders as much, but we're going to be looking for spots of mass herd buying and mass herd selling to try to trade against them. So within any uptrend, there are four different kinds of buyers that we have. The first type is a positioned seller, or a trader who has gone short. That may seem odd at first, but a trader who has gone short actually becomes a potential buyer. And the reason that is because many retail traders typically trade with 100% possible leverage or 100% of their possible capital. And because of this, once a trader does go short, he or she typically can't sell anymore, making it harder for price to go lower. Not only that, but for a short to exit the market, he or she must cover, meaning buy back into the market, whether at a loss or at a profit. And when they do buy back in, when a short converts either back into their initial capital or they flip their position into a long, they're going to be buying. So a position seller actually becomes a potential buyer. There are three different kinds of sidelined buyers as well. The first type of sidelined buyer we have are bidders. A bidder is a trader who puts a limit order to buy, but has not had that limit order executed yet. What some traders may notice is that when many other traders are trying to put limit orders to buy, bids, you may not be able to get your own bid filled as there's a large amount of demand, and that large amount of demand causes price to continue to move upward until the demand meets supply. Because of this, it's actually bidders who lose overall, as their bids do contribute to the uptrend gaining momentum and gaining demand, but typically retail bids only get filled at the top of an uptrend, as that's when the aggressive market selling begins. Third, aggressive buyers also propel an uptrend higher. An aggressive buyer, what I mean by an aggressive buyer is a trader who uses a market order to transact at an offer. What that means is imagine that a trader had gotten stopped out of his long position or panic sold out of a long position and then begins to see price rise. Not wanting to miss out on the potential price move and the potential uptrend, he or she buys into the market using a market order, and this causes the market to go up in the short term. The final type of buyer that we have are investors. Investors come and go, and they can be more fundamental or long-term technical analysis traders. But when we get a large amount of investing or a large amount of long-term buying, that's when we're also going to see price begin to rise. When we look at a downtrend, we have three main types of sellers. Positioned buyers, or traders who have previously gone long, are one position buyer, as a long who has used 100% of his or her capital can't buy anymore within a downtrend, so it's going to be hard to propel price upward in that sense. And secondly, to offset that long position, you have to sell to go back into your initial capital. So that's going to continue to propel the price lower if we have a large amount of longs. And if we have a large amount of shorts during consolidation or during a downtrend, then that's going to cause the market to go up, as position shorts are what caused the market to go up after all the shorts who wanted to short have sold. But going back to a downtrend here, it's not just position longs that cause the market to move down after they buy, but also askers. So these are traders who put limit orders to sell, but have not had their limit orders to sell yet executed. What this is going to do, especially if there are many more asks than there are bids, is going to create a supply-demand imbalance where there's a large amount of supply, not a large amount of demand, and price is going to continue to move down until supply meets demand. Finally, the third type of seller we have are aggressive sellers. These are sellers who may be on the sidelines and looking to either long or short, and they decide to short. And in that moment where they do short, that's going to cause the market to move lower. As I've mentioned a few times before, it's only after a trader who has gone short, he becomes a positioned short, which becomes a potential buyer. But during the moment that a trader shorts or during the moment that a trader longs, that's when they're actually be moving the trend in their desired direction. Now, I don't want to just talk about position buyers and potential buyers without talking about how they flow into one another and in a pendulum. So imagine any kind of uptrend or any kind of downtrend as a pendulum. From the beginning of that uptrend is when you have the maximum amount of potential buyers. So we're here with this pendulum. Imagine this vertical line is the pendulum. The end of that uptrend is going to be when we have the maximum amount of positioned buyers, meaning everyone who wanted to buy into the uptrend has already bought. Now, once we have the pendulum switch from here to here of the uptrend, what we're going to see is if we have the max amount of positioned buyers, what that does is creates the max amount of potential sellers. As many traders who had gone long during the uptrend have the ability to sell, which is going to cause a potential seller, which is going to cause the market to move lower. And anyone who wanted to buy or wanted to invest has already done so. So at that point, price is going to begin to move lower as we get the max amount of potential sellers. And the pendulum switches again. Where at the beginning of the downtrend, we start here with the max amount of potential sellers. And then at the end of the downtrend, we get the max amount of position sellers right here. Now, if that doesn't make sense with explaining buyer and seller exhaustion, as the pendulum switching from here to here or from here to here would be buyer exhaustion, and seller exhaustion would be potential sellers all becoming position sellers. That would be seller exhaustion. Let me show a visual example using the infamous run up to 20K down to 6K. What we saw here was this first phase here, we had the max amount of position buyers that became the max amount of potential sellers in phase 2. So what that means is that we had a large amount of buying here as we got investing back to here. We had investors during this run up. We had traders aggressively market buying in. We had traders trading on margin. We had many large bid orders that were keeping price moving upward and preventing it from moving lower. And we also had some shorts that were buying in there as well. Shorts that were covering that would propel price upward as they tried to trade against the trend. What that eventually came when price went to 20K was we had the max amount of potential sellers. And what that caused was the pendulum to switch from here to here, end of trend. And at that point, we had the minimal amount of potential sellers, the max amount of potential sellers and the lowest amount of position sellers. At 20,000 here, the reason I say there weren't that many position sellers is if you had told anyone that you were short at 19,900, when price was 19,900 during December 17th, people probably would have called you crazy and you would have been in a very small minority. If you had said that you were long, everyone else would have said they were long too, and they were happily making large amounts of profit during this run up. They would probably be talking to each other of who bought at the lowest price. And it's at that point that we have the maximum amount of potential sellers. And that's when we get all of these sellers who are going to begin to sell down. And that's what caused this with phase 2. Phase 2 here, you can see that the potential sellers sold and price went down. Now, I labeled phase 3 here, but I don't know for sure if this is going to be the final reversal. It may or may not be, but if it is, then we may have reached the maximum amount of potential sellers. As when the pendulum's switching, from like here to here, as it may have at the price point here, and then, we get a lot of selling, so maybe the pendulum goes to like here, we get some buying, the pendulum goes to like here, then we go back down to here, maybe the pendulum is here. What that means is that everyone who wanted to sell, all of the potential sellers, have become positioned sellers. So a position seller is a trader who aggressively selling, are putting many limit orders to sell, and some longs who are getting stopped out or getting liquidated. And that might have just happened here, which creates liquidity for price to move upward. So I don't want to just talk about position sellers and position buying and the pendulum switches that we get of those, but I also want to talk about stop loss hunts that create buyers and that create sellers. So what I mean by this is what happens when price goes slightly below a low. Longs are going to get stopped out, as when price goes slightly below a low, that's going to trigger many stop losses of longs selling. We get panic selling as a trader who doesn't have their stop loss down there sees that energetic selling past a low and they sell as well. And finally, we get shorts trying to profit off of the fear that's causing price to move lower. So what's going to happen here when the stop loss hunt does work successfully, meaning price goes below a low, then springs right back upward and price begins an uptrend? Well, what happened here was we turned many position buyers into potential buyers. So traders who were holding their bought position, the retail traders who had already bought, got stopped out, panic sold, or flipped over to become a short. And what this causes is a large amount of liquidity for potential buying. So one example of what exactly that looks like is here. Imagine this first phase as we get phase one, where buyers begin to enter the market. We see volume spikes up here, as the majority of them likely bought in here, indicated by volume. And some of them may have bought down here as well. And then after this occurs, we see that as price goes down, price goes slightly below the low here, low being at 445 on Ethereum. Price goes down to 443. Stops out many retail traders. As you can see here, panic selling occurs and shorts begin to open. Price springs right back up as all of the positioned buyers who had bought in here became potential buyers who have not bought in the market yet. As when you get stopped out here, they might not buy in back immediately. They're still waiting on the sidelines to try to buy back in. And what happens is that the final phase, phase three, as potential buyers become position buyers, occurs right here, where all of a sudden price begins to move up on high demand and high bidding pressure, and the sideline traders here, who are potential buyers, rush to buy right in. And that's what creates this large uptrend as price moves higher. So that's what it looks like for when price goes slightly below a low, and sometimes we get a stop loss hunt that creates a large amount of potential buyers out of positioned buyers. Again, imagine the price goes slightly above a high, and there's actually a pretty good example of that right here. Shorts are going to get stopped out, who put their stop losses right there. We're going to get fear buying, so fear of missing out buying. And we're also going to see some longs opening positions who may have been on the sidelines and are trying to pick a lane. So when we actually got that, we can see that we had a volume spike here as we got many buyers entering the market. And any buyers who hadn't bought into the market here, when price goes slightly above that high, we're going to get a lot of buying. And we're going to get a lot of buying from those shorts getting stopped out and also from those longs opening positions. And what this is doing is this is turning the previously positioned sellers, so shorts, traders who have already sold, longs who are not in the market, they're positioned sellers if you are holding your initial capital, into potential sellers who have the potential to short, who have the potential to exit their longs. And that's what happens here as price moves back downward. And we do get a spike in selling here as indicated by volume before we get the final stop loss on, just to convince the retail crowd that the market's going to move lower. And that's where we get all this potential buying that can occur to create the price run up. Now, quick disclaimer on stop loss hunts. They are not always going to happen. As you can see here, when price goes above this major high, this major resistance line about here, price just continued to go higher. Why does that occur? Well, that occurred because we didn't max out on position on potential buyers. Of the pendulum, imagine that this is the uptrend. At this point here, when price went just above this high here, we weren't here where we maxed out on position buyers, but we actually had a point where there was enough demand for price to continue to go higher, as not everyone who wanted to buy into the trend had bought. So the pendulum was probably somewhere around here, and then we did get some stoppage of price back up when price went to about here. Okay, so that covers where do we find buyers, where do we find new sellers with those stop loss hunts and with those panic moves. But I also want to answer the very common question of a trend of, in a downtrend, why does support become resistance? What's the actual theory behind that? In an uptrend, why does previous resistance become support? In an uptrend where price goes up, creates resistance, and then continues to go up, and then goes back down to that previous resistance, establishes it as support before moving higher. Now, the reason why support becomes resistance in a downtrend is this. So here's a visual example here. We get buyers who buy at support before price moves lower. So as you can see, price moved lower here, but we had some buying here. How do I know that traders were buying at support? Well, the whole reason why support does form is because there was an amount of buying or exhausted selling that occurred at that price level. So we can see here we have a volume spike of likely exhausted sellers, meaning everyone who wanted to sell has already sold. The pendulum's all the way over here. We begin to see some buying here, get some buying here, we get some buying and buying. So we have a lot of buying around this support level here. And then price goes lower. And these buyers are in pain. They're at a loss, and they don't want to take a loss. The traders who hadn't gotten stopped out of their longs probably want to sell at break even. So what's going to happen? Well, it's not just buyers becoming potential sellers, but there are certain price points where those buyers are likely to become potential sellers. And that price point is when price goes from this previous support in the downtrend, moves upward, and establishes it as present resistance. So it formed resistance here as price couldn't go past 72.80 because so many traders who had bought here sold here. And there just wasn't enough demand for price to go higher, and there was a large amount of supply that caused price to go lower. As price ventures back into previous support, boom, and losing buyers sell at break even. Take profit or lose out right here. And then price continues to move downward as the selling continues to press price lower. So far we've covered the theory behind overbought, oversold, which is looking at buyer-seller exhaustion with that pendulum. We've looked at stop loss hunts, that's creating buyers and creating sellers. And finally, we've also looked at why does support become resistance in a downtrend? Why does resistance become support in an uptrend? But what I want to talk about is volume and volume spikes. How can you actually predict trends using this kind of theory when we look at volume? So the first thing that I want to say is that the point of maximum apparent risk is typically the point of maximum opportunity. And one quick example of that would be here. And I will explain this. Probably looks terrible right now. But notice here that if price was at this point here, you didn't know any of this. This was actually the best possible spot to buy into the uptrend theoretically. Would have been here. The best possible spot to sell into the downtrend actually would have been here. And this looks, very bullish if you had stopped the candle right there. Best possible spot to sell would have been here. If you had stopped the candle here and didn't know, this looks like high demand. So it's really, whenever you're trading and you're looking for these pendulum switches, you want to know that the point of maximum risk is typically the point of maximum opportunity. So if you're trying to reversal trade, keep that in mind. A spike in volume during a trend can signal a shift in the pendulum from here to here. So what this does is position sellers, so shorts, longs who just sold out, or longs who got stopped out. They all become potential buyers, as retail traders who have gotten stopped out of longs or have gone short all have this buying ability now, as price is beginning to go higher, and they're itching to FOMO right into the trend and cause it to go even higher. Additionally, position buyers, so again, think of that 20K run up where price is just spurting up to 20K. All of those position buyers actually do become potential sellers. And that's what we saw with price going down from 20K down to 6K. So now let's dive into that, what looks like a kind of crazy example that we have here. So showing this is what happened today on July 6th. We're going to look at volume and look to see when it would have been best to buy and sell. So what's happening here? First, we see that position buyers become potential sellers. We get a large amount of buying here. We get a large amount of buying here. And we get these price tails that typically mean that price is going to move lower. All of these traders who are buying become potential sellers for the downtrend. And then the potential sellers all sell, as you can see here. And then of these potential sellers, as they're selling, they begin to become positioned sellers. So just going back to this one here, the pendulum switching from, here, that it was where the max amount of potential sellers was here at the top of the price range. It began to turn into here, where everyone who wanted to sell has done so. Potential sellers become position sellers, indicated by a volume spike here, a selling volume spike here, and a selling volume spike that occurs here. So all of these position sellers become potential buyers as the cycle just continues to move over and over again. And these position sellers become buyers and begin to buy the run-up, as you can see up to here. And this occurs until we get potential buyers that become all position buyers, meaning longs who are on the sidelines just bought. And a lot of them buy right here when they see high demand. And then price begins to move downward. As you can see, these position buyers become potential sellers, and they sell down, and then the potential sellers continue to sell here as price does move lower. So that's what we're looking at with this picture here. But one thing just to think about are that multiple volume spikes in a trend can signal that position buyers, so for example here, could become potential sellers. So if you're seeing a large amount of buying, but really not a lot of price movement, then that could be an indication that price might be moving lower in the short term. But you may counter with, yeah, but look what happened here. We had a large amount of volume and a large amount of price movement, which is a little bit more complex, as you can see with this price move here. But what happened was that all these position buyers sold. They all became position sellers, shorted, sold. And then one indication of that wouldn't just be the high momentum in the volume, as that can mean many things, but the lack of follow-up. Here, we're just not seeing a lot of follow-up. And when I say follow-up, what that's referring to is the order book. If we had a very strong order book, if we had a lot of potential sellers who were still wanting to sell, we would see large offering pressure, meaning many limit orders to sell, meaning price is going to have a harder time to go higher. We don't see that here. It looks like we really don't have that many offers, as volume is not really that high, but price is going higher, meaning that there probably isn't a large amount of order book resistance to the upside. So price just continue to go higher at this point. And also at this point, we see that potential sellers became position sellers, as traders who saw this run up, retail traders may see, all right, this is just a move back to previous support becoming future resistance. Let me short here. And then many of them may have sold here. Sold here and sold here because they think price is just going to continue to move lower. And then to their horror, price shot up to the upside. But it is interesting to see that it happened twice here, where support became resistance here, as any losing buyers sold at break even. And then here, any traders who had sold and were happy here and held their positions became losing sellers, and they bought at break even here, which caused price to not go lower than this previous resistance that became support here. And price went higher, then lower, and then it recently went higher and then lower again. But that's one way that you can begin to look at a trend, is to look at these types of moves happening, where you get a large amount of position sellers becoming potential buyers, or a large amount of position buyers becoming potential sellers, as indicated here, as price should not be having this easy of a time moving upward. If this is a strong downtrend, price should barely be moving upward. And when you see a large move like this, and then price rebounding almost immediately, typically price isn't going to move much lower than that point in the short term. And then here, we see something very similar. If you only had this price information available to you, you didn't know anything here, you just see that doji and that high tail. We see a large amount of buying. And what this might indicate to you is that a lot of potential buyers have already bought. They've become positioned buyers. No more traders on the sidelines. No more investors in the short term looking to buy Bitcoin here. And what that's going to do is cause price to begin to move down. And if you're not sure, and you may say, well, when did this trend end? What if the trend just kept going higher? Well, this type of move right here, just in isolation, should not be happening, because we should see a large amount of bidding pressure. We should see a very strong order book that's preventing price from moving any lower. We don't see that here. We see rapid movement to the downside after rapid move to the upside, and that's why price had a much harder time moving higher here. Then after we get these sellers, where these, as you can see here, the potential buyers become position buyers, and then these potential position buyers begin to sell off. We get another run up back up to here before we get this. All right, so that's going to do it for just this kind of long video on buyer-seller exhaustion and looking at position versus potential buying and selling in a trend. If you get one main takeaway from this, or two main takeaways, one would be always think of volume and price action in relation to a trend and its exhaustion. And the second one would be think of a trend as a pendulum, and that as the pendulum goes from really maximum potential buyers, beautiful beginning of an uptrend, to maximum position buyers, end of an uptrend, you can begin to see this pendulum visually with volume and even with sentiment as well, and make moves accordingly. All right, so with that, happy trading and hope you enjoy the video. Have a good day.